So anyone says to you that rising interest rates, rising inflation is not good for precious metals, then think again. We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's Hi everybody, Patrick Karim with Kevin Wadsworth. We're at NorthstarBadcharts.com, and today on Talking Trades, Kevin's going to show us this crazy 10-year yield chart and something he calls the pain line. Kevin, can you show our viewers there what's this pain and what it means for their investments?
And what I want to talk to you about now is the risk involved in what's going on in the broader economy and in the big picture. So give me a moment to share my screen. I will do that right now. So what you're looking at here now is the US 10-year yield chart. And this is the bond yield, the US government bond yield. You can do it on the 10-year yields, you can do it on the 30-year yields. And I just want to illustrate here the era that we're in. We talk about precious metals and precious metals eras and precious metals preserving purchasing power and preserving wealth. And it's particularly important at certain points in history. There are certain times that come along when it is even more important and more crucial that you understand what gold and silver do and what they're about to do in the economic environment that we find ourselves in. I drew this chart a good number of years ago now, at least 4 or 5 years ago, and I called it the pain line, this descending trend line. And anybody that understands technical analysis will understand that trend lines, resistance lines and support lines are very important because they mark trend changes. When you can identify a trend and you can draw a resistance line or a support line for that trend, what it does, it enables you to identify when that trend has changed, when it's finished, when it's over, whether it's the price of gold, the price of silver, whether it's stock markets, cryptocurrencies. Everything's cyclical in life, and the same applies to the markets. Now, with the US 10-year yields, it's particularly important in the way that it relates to debt and GDP and debt to GDP and the sustainability of the financial environment that we have, the economic environment that we have. You can see that in the 1950s, in fact, we broke out following World War II and began to rise. The 10-year yield began to rise, and it went up through the 1960s and entered an era during the 1960s and 1970s of ever-increasing bond yields and interest rates and inflation. That went on and on to the 1980s, and eventually economic policy triumphed, if you like, and we entered another era. So there's 4 eras or 4 sort of epochs on this chart. The one on the left-hand side, the one after it broke out and went up to 1980, then the one where we saw more than 40 years of descending bond yields, descending rates, and falling inflation, generally speaking, over a 40-year period. And that ended very abruptly. And when you get a very abrupt end to an era like this, and it was during the COVID-19 pandemic, and a lot of the charts show this anomaly here, it was a very, very abrupt end. And at that point there in 2020, it became very clear to myself and others who observe these things that something pretty dramatic was about to happen. And as this bond yield began to rise, we saw an ever-increasing likelihood of a violent break to the upside. A lot of people didn't really believe that, I suppose, because of debt sustainability and all the rest of it. You have to bear in mind that during this period in the 1970s, debt to GDP was falling. So the situation was somewhat more sustainable than it's likely to be if we repeat that process now, because debt to GDP has risen from somewhere around the 30-40% mark to somewhere around the 130% mark. So debt to GDP, that whole equation is very, very different now. So rising bond yields and rising interest rates are going to become much more problematic, much more quickly than they did during the 1970s. And we may well find that a 5% level has similar crippling economic effects as the 10 or 12 or 13% level did in the 1970s. And this is important for precious metals because, as we know, precious metals went on their biggest bull run in history during the 1970s in exactly this environment. So anyone says to you that rising interest rates, rising inflation is not good for precious metals, then think again, because I think a lot of people are just very used to what we've been seeing over the last 40 years. And we need to look further back to the 1960s, the 1970s, and even during the pre-war and war years as well, bears sort of eerie similarity to what is happening today. And gold is already reacting to that. Gold is breaking out to new all-time highs, not just over here where I am in the United Kingdom, not just in Canada, Australia, not just in Japan, but right around the world. In the United States, the US dollar, gold priced in US dollars, has followed all of those other currencies, and the World Currency Unit as well, which is a basket of currencies reflecting gold breaking out to new all-time highs. Silver is following as well, of course, and there's a lot of analysis behind what's going on with gold and silver that we can share in later episodes as well. But this is a fascinating chart for those of you who are wanting to position yourselves ahead of what is coming.
I'll tell you one thing, Kevin. When I'm looking at that chart, that looks like a whole bunch of charts. It looks like the oil chart. It looks like a whole bunch of commodity charts, right? They track to a certain extent the yields. And it's not just gold, guys. If you're in an uptrend, and the definition of an uptrend, guys, is higher lows and higher highs, you're starting an uptrend, right? As long as you keep repeating higher lows, there's pullbacks, and higher highs, then you're an uptrend. So there's a whole bunch of stuff that's tracking that 10-year yield chart. But you could also say it's a chicken and egg move thing. Well, maybe the yields, then they're just tracking the oil price, right? Maybe they're just reflecting the inflation in all the other commodities because they're destroying the purchasing power. But it is definitely supporting evidence. And that zoom out, Kevin, again, you get to see these huge cycles, which nobody's traded in the 1960s. That's probably like, we know a few there, but most people, the new traders here that have 20, 30 years, a lot of them didn't even see 2008. A lot of them didn't even see 2000. But these cycles are 20, 30, 40 years old. So you need charts. If you don't have charts, you don't understand what's happening. And the recipe you're using now, you think it's going to keep going on and on. But if you can't recognize that you have a pain line or a 40-year descending trend line that's broken out of, then you won't understand what's happening, right? You need that evidence to understand that the dynamics are changing, and assets where we used to say dead man walking, nobody would buy the dips, let's say in oil, but now it's the opposite, right? The dips are opportunities, right? Guys, thanks for watching Talking Trades. Make sure to follow us to get all the latest updates and next content.